If you have spent any amount of time on Instagram or YouTube, you would have seen thousands of trading videos showing you flashy watches and rented cars, promising you thousands of dollars as profits. But if you have any semblance of a working brain, you would know that trading is extremely difficult. So my goal for today is to make sure that trading is as straightforward as possible for you in the next 30 minutes. It is a big promise that I hope to deliver on. Now, if you don't know who I am, my name is Nick, and I'm a multi-7-figure trader, taking home profits like these month on month, and I have absolutely nothing to sell you. From 7 years of heavy analysis and charting, what I found to be the key to making trading straightforward is the ability to define and understand each concept that I personally use. This understanding enables me to implement these concepts with absolute confidence and sniper precision. So allow me to simplify all of trading for you in 3 simple steps. Step 1, figure out where is price going. Step 2, figure out how price is going to form a specific pattern that signifies where it's eventually going to go. And step number 3, figure out what is the best entry position. Simple, right? Let's get right into the video.
So let's start out with figuring out the very first step of where price is going to go. To do this, we are going to do top-down analysis. The whole purpose behind the top-down analysis is to find out the answer to the question, where is price most likely heading towards? That is our bias. Once we find our bias, we need to find out how is price going to deliver there, whether be it a simple candlestick confirmation or order blocks or fair value gaps. These are patterns on the charts you need to pay close attention to in order to get in before the big move happens. So of course, the natural question is, how do we find our bias? Before going any further, let's dive into what is a bias. I've been saying it quite multiple different times already, so pay close attention. Most people confuse it to be general movement in price, but it's not. It is a target. You see, in price, we have multiple PD arrays or premium and discount arrays. Now, if you're new and you don't know what a PD array is, don't worry. I'll explain it a bit later on. In this video, I'm going to focus especially on the fair value gaps as our PD array. But to be factually correct, PD arrays consist of order blocks, mitigation blocks, breaker blocks, fair value gaps, and swing lows and swing highs. Again, if you're confused, these are just specific patterns on the chart. I've done multiple YouTube videos explaining them, but I will simplify everything for the sake of this YouTube video with examples later on. So, to circle back to the original question of how do we find our bias, we look for a price target. This price target is going to be a PD array. Why? Because price always moves from premium to discount, back to premium, and back to discount, and so on and so forth. And so as traders, our job is to figure out which PD array is going to move next. Now let me explain. Let's take a look at this in action on the silver chart. Let's start off here at the daily bullish fair value gap as seen over here. Number 1, this is a discount array because the fair value gap is a bullish and not a bearish one. We are going to move from discount right over here to premium. The premium array target is the swing high right over here as seen as number 2. Once we reach that, we move back into the next closest discount array, which is this bullish order block seen over here at number 3. After that, we need to look for the next premium array again, which is this swing high at number 4, which is a daily high towards the left. We move so much higher after creating a new swing high right over here at number 6. Now, soon after, we reach for yet another bullish fair value gap marked out by this 3 candlestick pattern right over here at number 5. And finally, target the swing high at number 6 to end it all off, because this is where we are looking to break the highs once again to take out liquidity. This is exactly how price moves from PD array to PD array. Now, I want you to remember this. Premium arrays are just areas on the chart where price is too high, so holders want to sell at a high price to take profits, and price comes down. The opposite is true for discount arrays, which are areas on the chart where price is too low and people want to buy in because it is cheap, so therefore price goes up. Now that you understand how price moves, the secret is this. Once we find out which PD array we are going to move to next, the question of where price is most likely headed towards is answered, and therefore establishing our bias. I'm going to be using the word bias throughout this YouTube video, so if you are unfamiliar with whatever I've just mentioned, rewind and watch this portion now. So now that we understand that price moves to a specific PD array, how do I identify which PD array price is going to move towards? That is where we are going to start on the higher time frame. Before I fully dive into the charts, I need you to understand the concepts you are going to use based on time frames, which will depend on what kind of trader you are. As for an intraday trader, I'm not going to look at things like market structure on the monthly time frame because market structure is mainly used to determine what the next 5 to 10 candles will do. What I'll do is look at the 1 or 2 candles on the monthly time frame to get a rough sense of what price is doing, but it stops there. As an intraday trader, I'm not interested in waiting 5 entire months to see the monthly market structure. I only want to know what the next monthly candle wants to potentially do. Of course, if you want to become a swing trader, perfectly fine, go right ahead. It will be a little different for you in terms of what time frames and concepts you want to use. But the overall premise and ideas that are going to be shared in this video stays the exact same. So let's hit back right into the charts. In order for me, an intraday trader, to find my bias, I want to focus on what the most recent candles can do, which means the candle that's currently forming and the candle after that. What I like to do is refer to the concept of respect and disrespect. If you struggle to find your bias, my advice will be to mark out every single PD array that I've mentioned earlier on and see how we respect them or disrespect them. So what does a respect and disrespect candle look like? For a respect candle, we have a bearish respect and a bullish respect. A bearish respect is where the candles have a long wick at the top, which indicates that we are respecting a premium array. So price reacts at this premium section and dumps. On the other hand, a bullish respect candle is when we have a long wick at the bottom, indicating that we are respecting a discount array. So price reacts at this discount section and pumps. For disrespect candles, it basically means that price doesn't react off the PD arrays and closes as a body candle close inside like this. A bearish disrespect candle means that price has a body candle close inside the premium array. A bullish disrespect candle means that price has a body candle close inside the discount array, signifying price does not care that it is in a discount array and chooses to stay low. Now let's take a look at the monthly chart on the USD JPY. Let's start by marking out some POIs or points of interest. Here we have the monthly bearish fair value gap right over here, which is signified by the gap created by the first and the third candles, and the monthly bullish fair value gap right over here, which is signified by the gap created by the first and the third candle right over here. Now, let's apply the concepts of respect and disrespect candle here on this chart. Initially, the first candle that taps into the monthly bearish fair value gap right over here is tough to call. We have a long top wick and bottom wicks, so it's not a clear respect or disrespect, so we don't exactly know what it is. So let's see what the next candle does. Now this is a disrespect candle. It closed above the bearish fair value gap with a body candle close over here, disrespecting this fair value gap. In the process, we also formed a bullish monthly fair value gap, as seen by the gaps created by the first and the third candles here. Now, let's see how price reacts off this. There we go. A perfect example of a bullish respect candle. A long bottom wick reacting off the discount array, which in this case is the bullish monthly fair value gap. Now, you may be asking, this is cool and all, but isn't this a bit too late to get involved? How are you going to catch a trade if by the time you wait for the next candle, the move is already over? This is where the concept of fractality comes in. Price is fractal. What does it mean? What you can see on one time frame is what you can see on other time frames as well. Let me show you an example. In an uptrend, you see one very huge move towards the upside like this. However, if you zoom into the lower time frame, price is creating minor pullbacks in the process to fuel the move higher. So how do we use this monthly respect candle to get entries? Let's zoom into the 4-hour time frame to see this same candle in a more zoomed in perspective. In the monthly bullish fair value gap I highlighted earlier on, all these 4-hour candles make up that single respect candle on the monthly time frame. Tell me, In this entire up move, surely you could get involved in some of this and make a profit, right? So let's get into exactly how you are going to do that. Let's use SMC concepts to see how we can get involved in this move. Take this 4-hour fair value gap right over here. Again, if you're brand new, fair value gaps or FVGs are formed when the first and the third candles have a gap. There are many unfilled buy orders over here, which makes it a good point of interest. If you are a beginner and don't understand how price moves, what is most likely to happen here is price is going to come back to test this fair value gap. Since there are so many unfilled buy orders here, the moment price comes down into this range, all the buy orders are collected, allowing the market to drive upwards. So as you can see here, price tapped into the monthly fair value gap and then created a 4-hour fair value gap of the monthly time frame. These are two very strong bullish confluence. Now, let's find the bearish argument in this price leg. There was this bearish fair value gap over here, but it has been tested already by this huge long wick. Therefore, we can assume that this already has been tested and is invalid to use again, and therefore we have zero bearish confluence against us. Now, with two strong bullish confluence and no bearish confluence, our bias is therefore bullish overall. Now that we have a bullish bias, let's find a sensible target price for entry. To me, this specific swing high here is a good target as that is our next premium array. Let me quickly bring you back to the questions at the start of the video. Where is price most likely headed toward? The swing high here. How is price going to deliver there? The 4-hour fair value gap right over here. With these two locked in, we can now look for our entry. This step is extremely crucial, so pay very close attention. When it comes to time frame alignment, you want to make sure that your entry time frame isn't too big of a jump from your top-down analysis time frame. The bigger the jump, the more fake the moves you have. My recommendations are as follows. If you're trading the monthly time frame for your high time frame direction, your entry criteria or your entry time frame is going to be on the daily or the 4-hour. If you're using the weekly, you want to be using the 4-hour or the 1-hour for entry. If you're using the high time frame as your daily, then you want to use the 1 hour as your entry time frame. And as you can see, 4-hour, you use the 15, the 1 hour, you use the 5 minutes. Alright, so now with that out of the way, let's go back to our example. Our top-down time frame in this case would be the 4-hour, as we are using the 4-hour fair value gap as an entry criteria, targeting the 4-hour swing high right over here for our take profits. According to the time frame alignment, we will use the 15-minute time frame for our entry. The entry criteria is as simple as it gets. I've already stripped it down to the bare essentials, so you can focus on identifying the highest probability, higher time frame confluences. These 3 steps are all you need. Step 1, tap into a higher time frame PD array. Like I mentioned, we are going to focus on fair value gaps. So you want to be looking at the higher time frame fair value gaps. Step 2, drop down to your entry time frame and look for a further fair value gap in line with your higher time frame bias. Step 3, enter the trade, placing your stop loss at the most recent swing point, targeting a 1:2 risk to reward ratio. If you don't understand what risk to reward ratio is, not to worry, we will go through it in the very next example. Now, let's go through this example step by step. We tap into the 4-hour fair value gap, creating these 3 candles right over here. That's step 1 done. On to step 2. Using the time frame alignment as shown earlier, we drop down to the 15-minute time frame to look for a bullish fair value gap, since there are no bearish confluences and only bullish confluences. Now, we move on to step 3, but pay very close attention to this part. You can see that we formed this bullish FVG, but the third candle here looks very bullish due to the candle closing very high here. This means that it has a less likelihood for price to come back down into the fair value gap. And therefore, we wouldn't expect price to come back all the way down here to only push higher again. Now, this is what we call a breakaway gap. In this case, you would enter on the close of this candle with stop loss at the most recent swing low, because we don't expect a retracement back to the area. If price does retrace there, the whole idea is invalid already. So what you want to do here is target a 1:2 risk to reward ratio. This has just been a sweet spot for me. Right? It's not too ambitious while still giving you a pretty nice potential return on your risk. Now, you will notice here that our target goes past the swing high. So we will risk manage by moving our stop loss to break even once the swing high has been hit. As you can see, my stop loss is placed here with a 62 pip stop loss at 140.695. Now, a 1:2 risk to reward ratio means that if I risk 62 pips, my potential target must be 2 times of that, which is 124 pips. Take profit as my target at 142.550. Right here, once price comes into the swing high, we shift our stop loss to break even after a while. And let's take a look. TP smashed. Simple enough, right? For those of you who were sharp enough, you would notice that there is another way to get involved in this move. Couldn't see it? Let's get back to the monthly chart. Remember how we used the 4-hour fair value gap to reach the 4-hour swing high? We can do the exact same thing from a monthly standpoint. Once again, using our guiding questions. Where is price most likely heading towards? The monthly swing high. How are we going to deliver there? The monthly fair value gap. So let's run through the entry criteria step by step again. Step 1. Tap into the higher time frame PD array. In this case, the monthly bullish fair value gap formed by these 3 candles over here. In this specific fair value gap, you can notice that there is no top wick on the first candle as seen right over here. But there is a bottom wick on the third candle. When you do see this setup in the future, just take note that you can use the candle body to identify a fair value gap as well. This is also bullish because we have disrespected the bearish monthly fair value gap as seen right over here with a body candle close. Alright, so let's move on to step 2. Drop down to the entry time frame and look for a fair value gap in line with the buyers. So we will drop down to the daily time frame to look for a daily bullish fair value gap. Over here, we can see that price has created a bullish fair value gap using these 3 candles right over here. Step 3. I will enter the trade placing a buy limit at this bullish fair value gap right over here with stop loss below the most recent swing low, targeting a 1:2 risk to reward ratio. Stop loss placement is placed below the most recent swing low right over here, so that if in any case, if price decides to break below the swing low, the trade then becomes invalidated because price would have created a lower low, which is a bearish sign. Since my take profit is before the swing high, I can comfortably let this trade run and ride the wave. It takes a while, but eventually, as you can see, price hits a full TP. By now, you would have noticed how a thorough top-down analysis essentially gives you trade opportunities after trade opportunities, if done correctly, of course. I will illustrate this with one more example. This is a daily time frame on the gold chart. You can see that here we have respected this bearish fair value gap with a huge down close candle after tapping into it. We also have created a further bearish fair value gap over here, right after with a swing low to target over here, locking in our bearish buyers. So where is price most likely headed towards? That swing low. How are we going to deliver? With this daily bearish fair value gap. Now, I hate sounding like a broken recorder, but for the last and final time, let's go through the steps. Step 1, wait for a tap into the daily bearish fair value gap right over here. Step 2, use our time frame alignment, drop down to the 1-hour time frame to look for a bearish fair value gap in line with our bearish buyers. Since we use the daily time frame to get our buyers, the time frame alignment will be on the 1-hour time frame. Step 3, place a sell limit at this fair value gap, which I know is extremely small, but still valid. Stops will be placed above the swing high, targeting a 1:2 risk to reward ratio. The reason why we have our stop loss just at the swing high is because we want to ensure that if we are wrong about the trade, we get out of it as quick as possible without holding too much drawdown. And as you can see here, price eventually smashes our full take profit, is what I like to say. But you'll soon realize that, oh shit, I freaking lost. Now, this is where the next part comes in. Understanding fundamental analysis. Fundamental factors are the main driving source behind volatilities in the market. When there's news, there is volatility. If you're brand new to Forex, here is how you access all the news that's going to happen throughout your trading week completely for free. Go to forexfactory.com. Over here, you'll be able to see your time of the day that you're viewing the website. If you find that it is different from your local time, click on the time and it will bring you to your time zone setting and change it accordingly. So for the specific time that you're trading, what you want to do is click here and select the current date range that you're trading. So let's say this coming week, I'm looking at the 2nd of September to the 6th of September. Click on these two dates and apply the setting. Now you'll be able to see all the news that's coming out for this entire week. Now, I'll group news into two different categories: tradable news and untradable news. Untradable news injects an extreme amount of volatility to the point of uncertain and unpredictable prices. This often leads to huge slippages and traders become the liquidity. Now, the only untradable news in this list is CPI, NFP, and FOMC, otherwise known as the Big Three. The reason why price did not seem to follow through on this 1 hour trade was because we had a CPI on Wednesday, throwing away all technical factors, piercing through the stop loss orders. If you're brand new, these types of untradable news essentially dictates how the overall sentiment on the US dollar is, which essentially affects all currency markets to a certain degree. Take this chart for example. As you can see, even currencies like GBP and GPY are affected by the NFP results, which is why it is wise to avoid holding trades throughout periods like these. Now, let's move on to tradable news. Things like your PPI, unemployment claims, retail sales, anything outside of the big three news that I mentioned earlier on. Those are your tradable news. Remember what I said earlier? News is volatility. When there is news, there is money being pumped into the market. The main reason why the market allowed us to take such a beautiful trade on Monday is because there was JPY retail sales and preliminary industrial production responsible pushing USD JPY higher. Remember, fundamental analysis isn't gambling on whether it will go up or down, as long as number one, you have a clear bias and you know exactly how price is going to move. Number two, what patterns price needs to show in order to deliver to that target price. And number three, following all the steps and guidelines listed above. That trade is going to be high probability, and news is just another factor that helps push it into more profits quicker. And finally, for the USD JPY swing trade, when you're trading such high time frames as a swing trader, you're not going to be as prone to market manipulations as you would be as a day trader or even a scalper. So you can choose to disregard news factors as a swing trader. That being said, it is always good to keep yourself informed about these fundamental factors so you can stay updated as much as possible to catch potential swing moves. Just to summarize whatever I've talked about for the fundamental side of things. Number one, news is a smokescreen for injecting volume into the markets. Trade when there is news and avoid days without volatility. Number two, avoid trading before or during the big three news days unless you are swing trading on the high time frame. Number three, as long as you have a clear bias and know exactly how price is going to deliver to that bias, you are setting yourself up for an extremely high probability trade.
Look, this trading strategy shouldn't be the only one in your arsenal because it lacks the things like confirmation factors. I did a video about liquidity just a week ago, which complements this really nicely with this top-down analysis process. Top-down analysis gives you an accurate bias and allows you to take extremely high probability trades, but should always be combined with other strategies in order to get better entries and exit points. So click this video right over here to watch last week's liquidity breakdown with a viable strategy that complements this top-down analysis video. Thanks for watching all the way to the end of the video. If you'd like to see more videos on different beginner concepts and strategies, then make sure to check out my YouTube channel right over here, as we have tons of video for you to learn from. We have also segregated some of the videos into different playlists, so it's easier for you to watch them separately. If this video has enlightened you in any way, shape or form, make sure to smash the thumbs up button for me. I would greatly appreciate it. I live stream every single day on YouTube, so make sure to subscribe to get alerted when I hop onto the live streams every London and the New York session. Do click the first link down in the description below to join our Telegram group with 72,000 members, where we send 5 daily analysis every single day to ensure you guys can catch the same trades that I'm personally looking at. Now, with that being said, rewatch this video, internalize and backtest this strategy for yourselves, and I will see you in the next video. Nick signing out.